Cullen was known for navigating successfully through the financial crisis and the mortgage crisis. So can the Texas-based bank now navigate through the energy slump? I'm joined by CEO Dick Evans. So nice to see you once again in New York.
It's always great to be here.
Well, you talked recently on your earnings conference call about what's happening in the energy market. Bring us up to date on where you are and concerns about non-performing loans in that sector.
You know, we're very fortunate. The non-performing loans really haven't showed up, and I think it comes back to the core of the kind of customers that we bank. And so while classified loans have gone up and special mention, which are two categories I talked about, which requires setting aside some reserves for, non-performing loans have been really done very well. I think one of the things in January when we came into this year and saw energy prices falling by about 50% then, and I really believed that the summertime right now would be when we'd see kind of the low point. And as we looked at the statistics of supply and demand in the world, we thought they would come back in the fourth quarter of this year. I think that's been pushed probably to the third or fourth quarter of next year. And the good news is the difference between supply and demand is really not that big. It's about 1.5 million barrels to 2 million barrels a day between 89 and 90 million barrels a day. So I think that's the good news. So it doesn't take a lot of movement to bring it back in balance.
In terms of writing new loans, how much new loan activity are you seeing, and have you pulled back a little bit in that sector?
Well, we haven't pulled back. As I always say, having done this thing, been in this business for over 40 years, we don't open the faucet all the way in the good times, and we don't shut it in the bad times. And quite frankly, in the bottom of the cycles is the opportunity to get those very best customers who have a strong financial position, good capital, lots of liquidity. And so we've actually seen good growth in our energy loans of picking up some customers we always wanted to bank.
Let's move beyond your banking sphere and Texas. I recently talked to one strategist who thought the next potential problem was commercial and industrial loans nationally, that with interest rates so low, a lot of loans have gotten written to support companies that maybe shouldn't have received those loans. Do you see a similar fear in terms of that loan market, or is there anything else that you see in the banking industry as a whole that worries you? I'm going to assume it's no longer mortgages because they've been so hard to get for people.
I don't see it as badly. I think you have to break, like everything in general about the economy, you kind of have to break down some of the pieces. I think that particularly those that are dominant in commercial real estate loans, if we see a turn and interest rates go up substantially and in the slower economy, you could see some problems. I think the bubble that has been created, in my opinion, from the Fed leaving rates too low, too long, has really been created. And take the energy business. There was too much money chasing too few deals a year ago in the good times. Today, there's still lots of money waiting to buy the problems, which is really a good sign in that regard. If you look at fixed rate loans that have gone into the permanent market, fixed at very low interest rates, as rates start to increase, that will cause problems. And so I think there are a lot of other factors, and probably the thing that I think is the biggest problem is these rates have really hurt the saver, the middle class and the low class. It is ironic who have saved money for retirement, and they just can't get the return on their money. What's worse is if they move into a higher risk investment, such as real estate or energy. I'm not saying that that's bad for the sophisticated investor, but many of these people don't understand the risk they're taking when they move out of a traditional protected deposit.
Into like a high yield credit, you mean, or a corporate credit?
High yield credit, or say an energy fund or a real estate fund. It's not that they're bad, the energy funds or the investment funds. It's the fact that you really have to understand the risk level.
Dick Evans, great to talk to you, and I will congratulate you on your retirement. It is going to be next spring, but you will leave the bank after 45 years, which is pretty impressive.
Thank you.
Take care. I'm Rhonda Schaffler for TheStreet.